Hey, how you doing? Today I'd like to talk a little bit about what I call the 10 cardinal sins of trading. Now, if you're a professional market maker or a hedge fund manager, you don't need to know any of this because you already know it. But if you're just starting out, or if you're day trading or swing trading as an amateur or as a retail trader, then these are things to avoid. So let's get going. Number one, swinging for the fences, meaning that when you go and put on a position, if you're buying $100,000 worth of Apple stock, even though it's a great company, if you only have $100,000 in your account, then you're betting it all. This is one of the most common mistakes of early traders, and you can really lose your entire account and then some. Don't swing for the fences. Break your account up into tranches or sections. So if you have 100 grand in your account, say, okay, I'm gonna have 10 sections of $10,000 each. That way, if I just trade with $10,000, that's 10% of my account. Number two, day trading every day. When we day trade, we might take a position for an hour, a half hour, 2 hours in the morning on, let's say, a Friday or a Monday morning at open outcry. We do not recommend day trading. In other words, don't sit there and just look at these numbers and get involved in trading every single day. It's really important to have other aspects of your life going. Trading is just a means to an end to make money. So I would recommend do not trade every day. If you make a good win or if you lose some money, it's a good idea to just step away from the market. Let the market reset, let your actual brain reset, and then you come back to it in a few days and you have a great objective view versus being buried in numbers, buried in candlesticks, as we say, analysis paralysis. So don't trade every day. So number three is not knowing your market. Whether you're trading futures, options, Bitcoin, any kind of trading, you really have to know your market. It's much like a fighter walking into the ring and not knowing the rules of the game, not knowing the boundaries of the arena, not knowing his opponent. When you don't have any information and essentially you're just trading on guesses or on emotion, the chances are you're going to lose money. Make sure you know the market you're trading, do the research, and do not trade something that you don't understand. Number four, trading on margin or shorting. If you're a beginner trader or you're not a professional, I would recommend not trading on margin. I know that if you have 100 grand in your account and they give you 4 times leverage in a retail account where you can basically be trading up to $400,000 intraday, it's just not a good idea, because if you have one wrong mistake, that account will get swept and you'll be sitting there with like 10 grand. By shorting, you automatically go on margin. If you short a stock, it's by default, you're on margin. If you're trading and you're going long and buying, not 100 grand that's in your account, but you're buying like $300,000 and 200 of it is on margin, then you're on margin. My recommendation is do not trade on margin. I never trade on margin. Professionals will trade on margin, okay? Professional market makers, hedge fund managers and all that. But if you look at even Warren Buffett, read some of his books, he says never trade on margin. Number five, no stops on stocks. A stop loss is exactly that. It stops a loss from happening. I've done this myself. I've gone in and maybe 10 or 12 years ago when I first started trading, you buy some stock, maybe it goes up and you have a win, so you think that everything's just going to go up. One of the things we look at is risk management. So if you buy, for example, $20,000 worth of Apple stock, you're going to want to make sure that you first figure out what you can lose. Remember, the professionals figure out what they can lose. That's their risk management. They don't worry about the gains, the upside. They're worrying about what are they going to lose on their position and how can we avoid that. So having a stop loss on a stock position in your account is extremely important, because it shows that you're doing your own risk management and you're not going to lose money. I mean, a lot of stocks, people think stocks just go up and up, and you can look at some of these tech stocks or some stocks like GoPro, they hit like $40 a share, $60 a share, and now they're trading at $8 a share. So use stop losses. It is exactly for that, to stop a loss. Number six, leaving options in the overnight. This is one of the most common problems that I see, especially when I talk to professional traders, guys that are at big institutions that manage retail accounts, that have lots of clients, and they say one of the most common problems is that people think options are like stocks, and they're not. They're options. They disappear if you're out of the money and you don't have. Leaving your options positions in the market over multiple days or even weeks, unless you really know what you're doing and you're hedged, this is a real problem for beginner traders. So make sure that you do not leave options sitting in your account overnight. Like I said, unless you really know what you're doing, then this is a recipe for disaster. Number 7, not using candlestick trading or some kind of algorithmic framework. I'll tell you this again, every single time I go into the market, I really try to plan the trade and then trade the plan. By doing this, we avoid a lot of confusion, a lot of extraneous information. We avoid having to go with our gut or use emotion as human traders, right? So what we want to do is we want to make sure that we're using a framework. Now, not everyone uses candlesticks, not everyone uses support and resistance, not everyone uses buy and sell signals. However, the combination of those three are so powerful because so much of the money today is traded by computer. More than 50%, I would even guess more than 75% of all money today is traded by computer, which means that those computer programs are actually working on support and resistance levels, whether it's the bond market, the stock market, the Bitcoin market, the futures market. I don't care if you're trading crude oil or if you're trading cattle futures. You have to trade within some kind of framework so that you know, what is my entry point? What is my exit point? What happens if this happens? What happens if that happens? And these algorithmic and support and resistance levels in trading will help you get there. Number 8, tips are for waiters. Now, there's nothing against waiters. I actually like to tip very good because they work really hard. But there's an old expression in trading classes, tips are for waiters. Don't take a stock tip from the guy sitting next to you on the plane or the guy at the bar. Do your own critical analysis. Take your own time to review, your portfolio, to review stocks in the market, to review things like Bitcoin or other futures and commodities markets. Never take a tip. I always say, hey, if somebody gives me a tip, I'm going to actually reverse it. So if somebody says, hey, go long Glue Mobile, I'm probably going to short that or buy puts on Glue Mobile. So that's just an example. But remember, tips are for waiters. Do not take stock tips. By not doing your own critical analysis, you're gypping yourself. You're shortchanging yourself. And over time, you're not going to develop the skills to spot things. So for example, for me, if somebody comes up to me and says, hey, this is great. I got this great stock. Blah, blah, blah. I never, ever, ever take the stock tip. So just remember, tips are for waiters, not for traders. Number 9, not planning the trade. In John Person's candlestick and pivot point trading classes, we used to take live trading classes out in Las Vegas where you go for 2 days and you just basically trade alongside these masters. They always tell you one thing: whatever your market is, whatever your stock is, whatever your options are, and then trade the plan. Very simple. Plan the trade, then trade the plan. And by not having a trading plan, you're doing yourself a disservice. You got to look at the ups and you got to look at the downs. So in other words, if the stock goes up, if it goes to a certain point, what am I comfortable with in terms of getting out at a position? Do I want to make 10%? Do I want to make 17%? If the stock goes down, like we said previously, a stop loss will stop your loss. So again, not planning the trade, then trading the plan is one of the biggest mistakes a beginner can make. So plan the trade, then trade the plan. Last but not least, number 10, tuning in to mainstream media and financial news. Now, these things can actually be good in terms of giving you a brief overall view of what the market's doing or what the world is doing. However, mainstream media now is very skewed. Obviously, everyone knows that mainstream media is owned by really 6 corporations. On CNBC, I like Jim Cramer. He's great. He's got a lot of energy, but that's not really the way you should trade, jumping up and down, hitting buttons and sound effects and thinking about things like a big video game, because it's not. It's your money. And if you're trying to do this to make some extra money for your family, you don't want to be sitting there jumping up and down, waiting with bated breath on Jim Cramer. Now, the guy is really good for fundamental analysis. Remember, you have fundamental analysis, which stocks are good, like an Apple or Amazon or Facebook, and you have technical analysis. In other words, what's my entry point? What's my exit point? How far is this going to go? Are there Fibonacci retracements, things like that. But tuning into mainstream media is one of the biggest mistakes you can make. I remember, in business school, I went to an engineering business school, and they said that they had done a study, I believe it was at MIT, at the Sloan School of Management. And they did a study where they took a group of students at the beginning of the semester, about 100 students, and they took 50 students and they said, okay, you guys do your trading, but don't look at any news. The other half, the other 50 students, did trading, all based on mainstream media, financial news, watching CNN, CNBC, and all this stuff. Well, let's guess which group made more money. It was the group that didn't look at the mainstream media and the news. Why? Because they're making their own critical analysis on things. They're determining their own positions. They're picking their own stocks. They're not jumping up and down every time Cramer hits a button to buy, 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 or sell, 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 or pigs get slaughtered. So my main advice on this one is to not pay attention too much to the mainstream media, especially the financial news. That being said, news is good, especially somebody like Jim Cramer. They're good for broad fundamental analysis. But if you're tuning into that stuff every single day, if you're trading and you have the TV on and you're not just using it for sort of a broad overall view of the market, a lot of times you can get crushed because the mainstream media and Jim Cramer, especially if you look at it, they're all promoting stocks. They're all promoting going long. Well, most market makers and professional traders and hedge fund managers will tell you, hey, there's long, there's short, there's hedged, delta neutral trading. So you can sit there and follow Jim Cramer all the way up into the booms of the market, and then when the market tanks, everyone's going to be sad. So don't just look at going long, don't just look at the mainstream media, don't just look at the financial news. Do your own critical analysis, and remember always, plan the trade and then trade the plan. And like John Person says, don't just beat the market, leave bruises.